Between 2022 and 2024, global central banks accumulated over 3,000 tons of gold, the largest stockpile since the Korean War era, and what they know that you do and could wipe out your savings overnight. 3,000 tons. That figure represents the most aggressive precious metal accumulation by monetary authorities in 73 years. During just the 24 months spanning 2022 and 2023, official institutions purchased more than 2,000 tons. Then came 2024. Through the first 9 months alone, another 1,000 tons vanished into sovereign vaults. These aren't retail speculators chasing trends. We're witnessing coordinated moves by the People's Bank of China, India's Reserve Bank, Russia's Central Monetary Authority, Poland's National Bank, Turkey's reserve managers, Singapore's Monetary Authority, and Czech financial officials. Even nations whose names rarely appear in financial headlines are hoarding the yellow metal like civilization depends on it. Here's the part that should alarm you. Monetary authorities don't operate on emotion. They don't rush into assets because of social media hype or price momentum. Central banks possess intelligence pipelines you'll never access. Their economic advisors have dissected every fiat currency failure across 5 centuries. They monitor real-time capital movements, settlement data, sovereign debt trajectories, and geopolitical threat assessments classified above your security clearance. Intelligence agencies feed them strategic forecasts about what rival powers are planning. When institutions with that informational advantage all swarm the same asset class simultaneously, they aren't rebalancing portfolios, they're bracing for impact. What impact? The systematic demolition of dollar hegemony. The erasure of $37 trillion in American obligations through history's oldest financial sleight of hand. Currency debasement disguised as gold recalibration. The identical playbook Franklin Roosevelt deployed in 1933. And you're about to watch it unfold in real time. When central banks stampede into gold, they're not investing, they're taking cover. In this presentation, I'll expose precisely what monetary authorities see that remains hidden from you, the classified intelligence they access, the timeline they're following, the specific mechanism positioning them ahead of the greatest wealth redistribution in modern history. Most critically, what actions you must take immediately before the window slams shut. Because once this mechanism triggers, once gold gets revalued and the dollar implodes, reversal becomes impossible. You'll either be sheltered alongside the central banks or buried under the rubble, with everyone clutching devalued paper. Let me reveal which side of that divide you need to occupy. Let's examine the numbers, because the magnitude is unprecedented. According to World Gold Council data tracking official sector transactions, central banks acquired 1,036 tons during 2022. They followed with 1,037 tons in 2023. Through the third quarter of 2024, they've absorbed 789 tons. With the fourth quarter traditionally strong, total 2024 purchases will likely exceed 1,000 tons again. That's 3 consecutive years above the 1,000-ton threshold. For perspective, prior to this cycle, the previous annual record stood at 656 tons in 2018. Before that milestone, you must rewind to 1950 to find comparable buying intensity. We've entered uncharted waters. But volume tells only half the story. Participant identity and motivation reveal the rest. China. The People's Bank disclosed 62 tons added in November 2023 alone. They reported continuous accumulation across 18 straight months through May 2024. Then reporting ceased. Not because purchases stopped, because they no longer want transparency about accumulation rates. Analysts estimate China added 300 to 500 tons in official reserves over the past 2 years. Yet those figures capture only declared holdings reported to the International Monetary Fund. China also operates state enterprises purchasing gold, the State Administration of Foreign Exchange, sovereign wealth vehicles, and investment entities exempt from World Gold Council reporting requirements. Aggregate all channels. And China likely stockpiled between 1,000 and 2,000 tons since early 22. They're accelerating, not pausing. Why? Because Chinese planners see exactly what's approaching. Dollar collapse is inevitable. When fiat fails, the nation holding maximum gold reserves wins. Russia. The central bank of the Russian Federation purchased 330 tons in 2022 alone, making them that year's single largest institutional buyer. Accumulation continued through 2023 and 2024 despite enduring the most punishing economic sanctions in modern history. Or perhaps precisely because of those sanctions. Consider this reality. Russia held $300 billion in dollar-denominated assets frozen by Western powers in 2022. $300 billion they believe safely stored in foreign banks and securities, confiscated without warning. Now imagine you're any country observing this precedent. China maintains over $1 trillion in United States Treasury holdings. What prevents Washington from freezing Chinese assets during a Taiwan crisis? Absolutely nothing. The precedent exists. So, what lesson does every central bank worldwide extract from Russia's experience? Don't accumulate dollar assets Washington can confiscate. Accumulate something untouchable. Physical gold stored in sovereign vaults in Beijing or Moscow or New Delhi. The United States cannot freeze it, cannot seize it, cannot sanction it. It's yours, permanently. Russia now officially reports 2,333 tons, comprising roughly 25% of total reserves. That percentage exceeds America's gold-to-reserve ratio based on official valuations. Russia holds more reserve exposure to gold than the United States. That's strategic, intentional positioning, because Russian authorities know what's coming better than almost anyone. They survived Soviet Union collapse. They watched the ruble become worthless in 1991. They've endured Western financial warfare firsthand. They read not buying gold expecting price appreciation. They rebuying because they re-preparing for a world where dollars are worthless and gold becomes the sole reserve asset that matters. India. The Reserve Bank of India added 33 tons in 2022, another 41 tons in 2023, and continues quarterly purchases. India officially holds 841 tons. Here's what most observers miss. Indian households privately own more gold than any government on earth. Estimates range from 25,000 to 30,000 tons held by families. That exceeds United States government holdings, exceeds China's, exceeds every Western central bank combined. India as a civilization, combining public and private holdings, possesses more gold than anyone, and they're still accumulating. Why? Generational memory of currency collapse. The rupee suffered multiple devaluations. Indian families and Indian monetary authorities understand that when currencies fail, gold survives. It's ancestral wisdom transmitted through centuries. That cultural knowledge is being validated right now. Poland. The National Bank of Poland acquired 130 tons across 2022 and 2023. Massive for a mid-sized economy. Their holdings jumped from 229 tons in 2021 to 359 tons by late 2023, a 57% surge in 2 years. Governor Adam Glapiński stated publicly that gold represents the ultimate safe haven, and Poland is preparing for reduced global monetary stability. Read that declaration again. A sitting central bank governor openly acknowledging preparation for systemic instability. He's not concealing it. He's broadcasting exactly what Poland perceives. The global monetary architecture is destabilizing. Translation: the dollar will collapse, and Poland is positioning ahead of the event. Turkey. Turkey's central bank added 160 tons in 2023. Turkey has experienced currency crisis for years. The lira imploded against the dollar. Inflation peaked at 85% in 2022. When you're living through real-time currency destruction, you buy gold. Turkey's monetary authority knows this from direct experience, and they're preparing for the next phase when conditions deteriorate further. Singapore. The monetary authority of Singapore has quietly accumulated. They don't publish monthly updates like some jurisdictions, but International Monetary Fund records show significant tonnage increases. Singapore manages reserves with greater sophistication than nearly any country. If Singapore is buying gold aggressively, it's not random. They perceive something. And Singapore doesn't make financial errors. Now observe what connects every single one of these transactions. Each central bank is preparing for an identical event: the termination of dollar supremacy, the collapse of the existing monetary framework, the transition toward whatever replaces it. They don't know the precise replacement structure. Perhaps a BRICS gold-backed currency, perhaps a basket of currencies, perhaps special drawing rights from the IMF, perhaps something not yet announced. But they know pure dollars won't anchor it anymore. During the transition from old architecture to new architecture, gold becomes the only universally accepted asset. You can't easily swap yuan for rubles. Currency swaps involve complexity. Exchange rates fluctuate. Political relationships influence terms. But everyone accepts gold. It's the ultimate neutral reserve asset. This explains why central banks are buying at volumes unseen in 73 years. They're preparing for reserve currency transition. And that transition is accelerating due to something most people ignored: the weaponization of the dollar. For decades, Washington deployed dollar reserve status as coercion. You defy American foreign policy objectives, we sever your dollar clearing access. We freeze your assets. We sanction your banks. We exclude you from international trade infrastructure. This strategy worked when alternatives didn't exist, when every nation required dollars for survival. But now, countries have reached the breaking point. They're constructing parallel systems, and they're backing those systems with gold. Let me expose exactly what's unfolding behind the scenes that mainstream media won't reveal. The BRICS bloc, Brazil, Russia, India, China, South Africa, has actively developed plans to launch a gold-backed currency since 2022. This isn't speculation. This represents official policy formulated by governments representing 40% of Earth's population and 25% of global economic output. At the August 2023 BRICS summit in Johannesburg, the coalition expanded. They invited 6 additional members: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. Some accepted immediately, others remained deliberating. But expansion proceeds. And here's what this means. BRICS nations are creating a parallel financial infrastructure, an architecture independent of the dollar, an architecture immune to Western sanctions, an architecture Washington cannot control. And the foundation of this architecture is gold. Here's the operational mechanism. Each BRICS participant contributes gold to a collective reserve fund. That gold backs a new currency deployed for international commerce between member states. When China purchases oil from Russia, they settle in BRICS currency backed by gold. When India imports commodities from Brazil, BRICS currency. When Saudi Arabia, if they join, sells petroleum to China, BRICS currency, $0 involved. This demolishes the petrodollar framework sustaining American power since 1974. The petrodollar agreement was elegantly simple. Saudi Arabia prices oil exclusively in dollars. In exchange, America provides military protection. Every nation purchasing oil needs dollars. That generates permanent dollar demand, allowing the United States to print unlimited currency without immediate inflation because those dollars absorb globally. But if Saudi Arabia begins accepting yuan or BRICS currency for oil, the petrodollar dies, dollar demand collapses, and all those trillions of dollars warehoused overseas flood back to America. That's when domestic inflation detonates. This isn't theoretical anymore. In March 2023, Saudi Arabia executed its first oil transaction with China settled in yuan, not dollars yuan. That was the initial fracture in the petrodollar system. Since then, more followed. Russia and India trade in rubles and rupees. China and Brazil transact in yuan and reals. The Association of Southeast Asian Nations develops regional payment infrastructure bypassing the dollar. Every one of these agreements diminishes dollar usage. Every reduction in dollar circulation brings us closer to collapse. This is why central banks hoard gold. They know the BRICS gold-backed currency launches soon, probably during 2025 or 2026. When it launches, it will immediately challenge dollar dominance. Countries exhausted by American financial hegemony will finally have an alternative, and they'll embrace it. Now, let me expose the mechanism through which this collapses the dollar and erases American debt, because this is where sophistication peaks. The United States government currently owes $37 trillion. The debt-to-GDP ratio stands at 132%. Annual interest payments alone consume $1.2 trillion. That exceeds defense spending. This debt cannot be repaid through conventional means. You cannot tax your way out of 132% debt to GDP. You cannot achieve growth when debt compounds faster than the economy. You cannot cut expenditures enough when interest alone devours 5% of GDP. Only one option remains: devaluation. But you can't openly print money because panic would ensue. You need a more elegant approach. You need to appear as though you're strengthening the dollar while actually destroying it. The method? Gold revaluation. Here's the playbook. It's the identical strategy Roosevelt executed in 1933, about to be deployed again. The United States government officially holds 8,133 tons of gold, roughly 261 million ounces. At current market prices around $2,700 per ounce, that's worth approximately $75 billion. But here is the critical detail. That gold is valued on official ledgers at $42 per ounce. That's the statutory price fixed in 1973. On official books, American gold reserves equal $11 billion, not $75 billion. $11 billion. This creates enormous room for revaluation. Watch what occurs when they exploit it. The United States announces a return to gold backing for the dollar. Not a full gold standard where every dollar converts to gold, but partial backing where dollars are supported by a percentage of gold reserves. This sounds conservative. Sounds like sound money. Gold advocates applaud it. Hard money proponents praise it. But it's a trap. Gold revaluation looks like salvation but functions as theft at the speed of policy. Because to credibly back the dollar with gold, you need sufficient gold relative to money supply. M2 money supply equals $21 trillion. The United States holds $75 billion in gold at current market values. That's only 3.4% backing. You can't claim the dollar is gold-backed at 3.4%. Nobody believes it. But if you revalue gold from $42 per ounce on the ledgers to $20,000 per ounce, suddenly you possess $5.2 trillion in gold reserves. That's 25% backing of M2. Now you can credibly market the dollar as gold-backed. You can sell it as a return to sound money. You can position America as the fiscally responsible superpower. But what you may actually accomplish is revaluing gold by 50-fold from the statutory price and implicitly devaluing the dollar by 87% relative to gold. Because if gold rises from $2,700 to $20,000, the dollar lost 87% of its value measured against gold, which means it's losing that much against everything else too: food, energy, shelter, everything. And here's the brilliance of the scheme. America's $37 trillion debt is denominated in dollars. Those dollars now carry 87% less real purchasing power. So the authentic debt burden measured in actual value dropped from $37 trillion to $4.8 trillion. They've erased $32 trillion in obligations, not by repaying it by devaluing the currency it's denominated in. They've confiscated $32 trillion from creditors, bondholders, savers, and dollar holders, and transferred it to themselves through reduced debt burden. This is the strategy. This is what central banks see approaching. This is why they're buying gold before revaluation executes. Let me show you the historical precedent, because this exact playbook was deployed before. In 1933, America was drowning in debt from World War I and the Great Depression. Debt to GDP approached 40% and climbing. Deflation devastated the economy. Banks collapsed. Unemployment hit 25%. The system was failing. President Roosevelt needed a solution, and he selected gold revaluation. In April 1933, Roosevelt signed Executive Order 6102, making it illegal for American citizens to own gold. You had to surrender your gold to the government. They compensated you $20.67 per ounce. That was the official rate fixed since 1879. Most Americans complied, exchanging gold for dollars. Then in January 1934, after the government collected most privately held gold, Roosevelt announced the revaluation. The new official price, $35 per ounce, a 69% overnight increase. Here's what this accomplished. The United States government now owns most of the nation's gold. At the old price of $20.67, their reserves were worth roughly $4 billion. At the new price of $35, those identical reserves suddenly equaled $6.8 billion. They manufactured $2.8 billion in value from thin air simply by changing the official price. But the real impact targeted debt. Debt owed by the government was denominated in dollars. Those dollars became less valuable relative to gold. Gold revaluation triggered inflation. Prices climbed. Nominal wages rose, but real wages stagnated. The actual burden of debt declined. By 1940, debt to GDP had fallen from 40% to 25%. Not because they paid off debt, because they inflated it away through currency debasement masked as gold revaluation. And American citizens who surrendered their gold at $20.67 and watched it revalued to $35, they lost 40% of purchasing power. They couldn't repurchase the gold at the new price. Gold ownership remained illegal until 1974. They were trapped holding devalued dollars while the government used their confiscated gold to erase debt and enrich itself. This is not ancient history. This is the playbook being deployed right now. And central banks see it coming because they've studied this history. They know what America did in 1933. They know it succeeded. They know it's about to repeat. Except this time, revaluation won't target $35 per ounce. This time, it's $20,000. Now, let me expose the three categories of intelligence central banks possess that you don't. This is why they're buying a signal you cannot ignore. First, they observe real-time capital flows. When money migrates from one jurisdiction to another, central banks detect it instantly. They track foreign direct investment, portfolio flows, which countries accumulate United States treasuries, which are divesting. And what they've witnessed over the past 3 years is a massive rotation away from dollar assets. According to IMF statistics, the dollar's share of global reserves declined from 61% in 2020 to 58% in 2024. That is a 3 percentage point drop in 4 years. Sounds modest until you realize that represents hundreds of billions flowing out of dollar-denominated holdings. Where is it migrating? Into euros, into yuan, into gold. Central banks are reducing dollar exposure not by preference, but by necessity, because they perceive the mathematical impossibility of America repaying $37 trillion in debt. They know devaluation is inevitable, and they're exiting before it detonates. Second, they access classified geopolitical intelligence. The People's Bank of China knows what Chinese military planners are strategizing regarding Taiwan. They know the timeline. They know which nations will support China, which will oppose. They know conflict probability, and they know what happens to dollar assets if that conflict erupts. The Federal Reserve accesses NSA intelligence. The Bank of Russia receives FSB intelligence. These institutions see threats invisible to the public. And the largest threat they all perceive is dollar weaponization. Since 2022, America has frozen $300 billion in Russian assets. That's the precedent. If Washington will freeze Russian assets, they'll freeze anyone's assets. China knows this. India knows this. Saudi Arabia knows this. Every country with substantial dollar reserves understands their assets can be seized instantly if they politically cross the United States. So what do? They relocate assets Washington cannot seize. Physical gold in vaults they control Beijing, Moscow, New Delhi. America can't freeze it, can't sanction it, can't touch it. Third, they possess superior economic data than the public. Official inflation in the United States registers 3.2% as of Q4 2024. But central banks employ different methodologies. They track actual price changes across thousands of commodities, wholesale prices, asset prices, money supply expansion. They know authentic inflation runs far higher than reported figures. M2 money supply expanded by 40% from February 2020 to 2022, 40% in 2 years. That currency didn't vanish. It's circulating. Eventually, it manifests as inflation. Maybe not in CPI, because the government manipulates that calculation to understate inflation, but in asset prices, tangible goods over time, central banks perceive this. They know inflation is approaching, not 3% inflation. 10%, 20%, possibly more when the next crisis forces additional money printing. And they're buying gold because gold is the only asset, preserving purchasing power through inflation, always, without exception, across 5,000 years of human civilization. When Weimar Germany printed currency in 1923 and the mark became worthless, gold holders preserved wealth. When Argentina inflated the peso in the 1980s, gold holders survived. When Zimbabwe printed $100 trillion notes in the 2000s, gold holders maintained purchasing power. The pattern is universal and unbreakable. Central banks buy gold because they see severe inflation approaching, the type that destroys currencies, the type accompanying governments forced to print money servicing unpayable debts. And they want positioning before impact. Now, let me reveal the timeline, because this isn't unfolding in 20 years. This is happening now and accelerating. Phase 1, 2024 through mid-2025 final accumulation. This is our current phase. Central banks are acquiring gold as rapidly as possible without spiking prices. They're employing multiple channels, direct mine purchases, transactions through intermediaries, taking delivery on futures contracts, buying from other central banks discreetly. The objective is accumulating maximum tonnage before revaluation. You observe this in the data. Every quarter for 3 years, central banks have been massive net buyers over 1,000 tons annually. At current prices around $2,700 per ounce, 1,000 tons equals $86 billion. That's central bank annual gold expenditure, $86 billion. Simultaneously, they're divesting United States treasuries. During 2022 and 2023, foreign central banks sold over $500 billion in treasuries, selling dollar assets, buying gold. The rotation is unmistakable. Phase 2, mid-2025 through 2026, the announcement. This is when BRICS officially launches the gold-backed currency. The declaration will arrive at a BRICS summit, probably June or August 2025. They'll disclose that participating nations have collectively deposited thousands of tons into a reserve fund. The new currency is backed by this gold. International trade between BRICS members settles in this currency starting immediately. Initial adoption will be gradual, a few bilateral agreements. China-Russia oil, Saudi-China oil if Saudi joins, Brazil-China commodities. But once infrastructure is operational, adoption accelerates because countries resenting dollar dominance finally have an alternative. Iran, Venezuela, Syria nations on poor terms with Washington will rush adoption. Then neutral countries, Malaysia, Indonesia, Thailand, Turkey. Nations preferring independence from the dollar, but lacking options. Now they have choice. Over 12 to 24 months, 20 to 30% of international commerce could shift away from dollar settlement. That reduces dollar demand by trillions, and the dollar begins falling. Phase 3, 2027 through 2028, the crisis and revaluation. This is when America is forced to respond. As the dollar declines and inflation spikes, the Federal Reserve and Treasury implement the gold revaluation strategy. They announce a return to gold backing. They revalue gold on the American balance sheet from $42 per ounce to $20,000 per ounce. This creates the illusion that America possesses massive reserves backing the dollar. But what it actually accomplishes is devaluing the dollar by 87% relative to gold. Your savings, if held in dollars, lose 87% of purchasing power. Your bonds become worthless in real terms. Your retirement account evaporates. Meanwhile, central banks that purchase gold at $2,000 or $2,500 or $2,700 per ounce now hold gold worth $20,000. That's an 8 to 10-fold return. China, as 2,000 tons of unreported purchases rise from 5.4 billion to 129 billion at 20,000 per ounce. Russia's reserves climb from 63 billion to 1.2 trillion. These nations profit by hundreds of billions, positioning ahead of revaluation. Countries holding only dollars lose everything. This is the wealth transfer from dollar holders to gold holders, from the West to the East, from savers to governments. It occurred in 1933. It's repeating in 2027. The only question is which side you'll occupy. Now, let me explain why gold specifically. Because you might wonder, if central banks want diversification away from dollars, why not equities or property or Bitcoin or other currencies? Here's why gold is unique and why central banks select it over everything else. First, gold has zero counterparty risk. When you own United States treasuries, you depend on Washington to repay you. If they default or inflate, you lose. When you own stocks, you rely on corporations to perform. If companies fail, you lose. When you own real estate in another jurisdiction, you depend on that country's legal framework protecting property rights. If the government nationalizes or imposes capital controls, you lose. When you own Bitcoin, you depend on the blockchain remaining secure and accessible. If there's a 51% attack or governments ban it or internet infrastructure fails, you lose. But when you own gold, you depend on nothing. Gold is an element. It exists. It holds value because humans have assigned it value for 5,000 years across every civilization. No government can print additional gold. No company can bankrupt and make gold disappear. No court can rule your gold invalid. No hacker can steal physical gold from a vault. You own it, period. For central banks managing geopolitical risk and the possibility of sanctions, asset freezes, or confiscation, this is critical. Russia learned harshly that Western dollar assets can be frozen. China knows their $1 trillion in treasuries could freeze tomorrow during a Taiwan conflict. But physical gold in Beijing? America can't touch it, can't freeze it, can't seize it. It's completely outside Western financial infrastructure. This is why gold is the ultimate safe haven for central banks, not for price appreciation, but for security and sovereignty. Second, gold is universally accepted. If Russia wants to trade with China, but China doesn't want rubles, they settle in gold. If India trades with Iran, but Iran doesn't want rupees, they settle in gold. Gold is fungible across borders. An ounce of gold is an ounce of gold whether mined in South Africa, Canada, or Russia. No sanctions on gold exist. You can't embargo gold. It's the ultimate neutral reserve asset transcending politics. This is why gold has been money for 5,000 years. And this is why central banks, when confronted with an uncertain monetary future and fragmenting geopolitical alliances, return to gold. It's the one thing everyone trusts, the one thing everyone accepts, the only universal money. Third, gold code cannot be hacked or digitally stolen. As the world transitions toward digital currencies and cyber warfare becomes a constant threat, central banks realize digital assets are vulnerable. In 2022, North Korean hackers stole $600 million in cryptocurrency from Axie Infinity. In 2023, over $2 billion vanished from various crypto exchanges and DeFi protocols. Digital assets can be hacked. Wire transfers can be intercepted. Bank accounts freeze with a keystroke. But physical gold in a vault with armed security and multiple protection layers? You must physically steal it. That requires infiltrating the facility, defeating security, moving tons of metal, and escaping. That's exponentially harder than hacking a computer system or issuing an asset freeze order. Central banks buying gold are preparing for a world where cyber warfare is perpetual and digital assets face constant attack. Gold can't be hacked, can't be frozen with a keystroke. It's the ultimate analog asset in a digital world. Fourth, gold holds value through inflation. This is the critical feature for central banks right now. They know inflation is approaching. When you carry $37 trillion in unpayable debt, when you've printed 40% more currency in 2 years, when you're running trillion-dollar deficits annually, inflation is inevitable. Bonds get obliterated by inflation. Real yields turn negative. You lose purchasing power. Cash gets destroyed. Even equities struggle during high inflation. The 1970s saw stocks flat nominally, but down 50% inflation adjusted. But gold? Gold rose from $35 per ounce in 1971 when Nixon severed the gold link to $850 in 1980. A 24-fold return while everything else was crushed. Gold preserved and multiplied wealth through the decade of inflation. Central banks buy gold because they see 2020's inflation resembling 1970's inflation, except worse because debt levels are higher, money printing will be more extreme, and inflation will be more severe. Now let me show you what this means for you. Because the smart money central banks with trillion-dollar budgets and teams of PhD economists is buying gold. The question is whether you'll follow their lead or ignore the warning and get destroyed. Here's what you need to understand about timing. When central banks buy, retail should have bought 5 years earlier. By the time institutional buying becomes public knowledge, you're late to the early phase, but still early to the main phase. Gold price in 2020 was $1,800 per ounce. In 2024, it's $2,700, up 50%. Central banks purchasing in 2020 already made 50%. If you buy now at $2,700, you're buying at prices central banks accumulated 2 years ago. Are you late? To the absolute bottom? Yes. To the big move? No. It depends on what happens next. If gold revaluation to $20,000 occurs in 2027, buying at $2,700 will look brilliant. That's a 7.4 times return in 3 years. But if gold stagnates at $2,700 for 5 years, you've made nothing and suffered opportunity costs. The bet you're making purchasing gold now is that central banks know something you don't, that their access to intelligence, economic data, and geopolitical information surpasses anything available publicly. And based on their track record, that's a safe wager. Central banks don't make $86 billion annual allocation decisions on whims. They're not gambling. They're positioning based on intelligence you'll never see. Following their lead has historically been the intelligent move. Let me show you the 3 phases of capital flight so you understand where we are in the cycle and when to position. Phase 1 is smart money, central banks, sovereign wealth funds, billionaires, ultra-high net worth family offices. They move first, quietly. No announcements, just accumulation. Phase 2 is institutional money, hedge funds, pension funds, endowments, asset managers. They move when the trend becomes undeniable. When central banks have purchased 3,000 tons over 3 years and data is published, institutional analysts notice. They write reports. They recommend allocation increases. Institutions start buying. This is the phase we're re-entering now in late 2024 and 2025. You're restarting to see hedge fund managers discuss gold. Ray Dalio has recommended 5 to 10% gold allocation for years. Paul Tudor Jones stated publicly he's long gold in Bitcoin. These are institutional voices. When they speak, institutions listen and allocate. Phase 2 is when gold advances from $2,700 to $6,000. That's the institutional wave. It hasn't fully arrived yet, but it's starting. This is your window to buy before Phase 2 runs. Phase 3 is retail panic. This is when regular people, after watching gold climb from $2,700 to $6,000, stampede to buy because they fear missing out. This is FOMO at scale. Your uncle who never invested asking you how to buy gold. CNBC running gold hits record high segments daily. The blow-off top. Gold rockets from 6,000 to 15,000 to 20,000 in compressed time frame. Pure mania. Everyone buying. This is when you should consider taking profits because retail panic is the terminus of the move. After retail panic comes the crash back to reality. Revaluation has occurred. Reset is complete. Gold stabilizes at a new elevated level but stops climbing. We're not in phase 3 yet. We're in the transition from phase 1 to phase 2. Smart money already bought. Institutional money is starting to buy. Retail hasn't noticed yet. If you position now, you're early institutional, not smart money, but not late either. You're precisely where you need to be. Here is the specific allocation I recommend. 10 to 20% of your liquid net worth in gold. Not your house, not your car, your liquid investable assets. For a $100,000 portfolio, that's $10,000 to $20,000 in gold. Here's how to allocate within gold. 70% physical gold. Buy 1-ounce coins or bars from reputable dealers. American Gold Eagles, Canadian Maple Leafs, Austrian Philharmonics. 1-ounce bars from recognized refiners like Pamp Suisse or Credit Suisse. Do not buy numismatic coins. Do not buy collectibles. Buy bullion weight-based value only. Store in a safe at home if you have proper security or in a private vault. Not a bank safe deposit box because banks can be closed by government order during crisis. Private vault services like BRICS, Loomis, or allocated storage at dealers. This is your insurance if the system collapses, if the dollar dies, if there's a bank holiday. You have physical metal you can hold and trade. 20% gold ETFs, GLD or IAU in the United States. These are paper gold but backed by physical gold in vaults. Advantage is liquidity and ability to hold in retirement accounts where you can't hold physical. Disadvantage is counterparty risk. You depend on the ETF structure remaining intact and the custodian actually possessing the gold. During a true crisis, there's risk of ETF failure or government confiscation of underlying gold. But for retirement accounts where physical isn't an option, ETFs are your best vehicle. 10% gold mining stocks. Barrick Gold, Newmont, Franco-Nevada, Wheaton Precious Metals. These give you leverage to gold prices. If gold rises 50%, mining stocks might climb 100 to 150% because their profits multiply. But they're also stocks, so they're more volatile. They can decline even if gold rises if there are operational issues or broader stock market crashes. Use this allocation as your speculative position for maximum upside. Now let me address the objections, because I know what you're thinking. First objection, but the government could confiscate gold again like 1933. Here's why that's unlikely this time. In 1933, the dollar was backed by gold. The government needed to accumulate gold to back the currency. Confiscation made sense within that framework. In 2025, the dollar is pure fiat, not backed by anything. The government doesn't need your gold to back the currency. They can print dollars regardless of gold holdings. Second, in 1933, gold ownership was widespread. Millions of Americans held gold coins as everyday money. Today, less than 2% of Americans own physical gold. It's a tiny fraction of total wealth. Confiscating it wouldn't yield much for the government. Third, enforcing confiscation today would be nearly impossible. In 1933, transactions were physical and local. Today, gold trades globally. Gold can be stored in other countries. Gold can move across borders. Enforcement would require international cooperation and massive surveillance. Not realistic. The more probable scenario is what I've described. Government revalues its existing gold reserves to reduce debt burden. Private gold holders benefit too, because the market reprices accordingly. Your gold rises from $2,700 to $20,000 along with government gold. You win, but your dollars get destroyed by the inflation that follows. That's the trade-off. Could they attempt confiscation anyway? Maybe, but even if they do, the months or years of warning before confiscation will grant you time to relocate assets, and the political backlash would be enormous. It's far more likely they simply revalue and let the market adjust. Second objection: gold doesn't pay dividends or interest. I lose opportunity cost. True, gold is a store of value, not an income-producing asset. But that's the point. During monetary resets, income-producing assets often fail. Bonds default or inflate away to nothing. Dividend stocks cut dividends or bankrupt. Real estate in wrong locations becomes illiquid. Gold doesn't produce income, but it also doesn't have the risks income-producing assets carry during systemic crisis. The opportunity cost of holding gold is offset by the protection it provides. And if gold advances from 2,700 to 20,000, the capital appreciation far exceeds any dividend or interest you would have earned elsewhere. Third objection: Bitcoin is digital gold. Why not just buy Bitcoin? Bitcoin has merits. It's scarce, portable, programmable. I'm not anti-Bitcoin. But central banks aren't buying Bitcoin at the same rate they're buying gold. China purchased 300 tons of gold in 2 years. They're not reporting 300 tons of Bitcoin equivalent. Russia bought 330 tons. Not Bitcoin? There's a reason. Gold has 5,000 years of history. Bitcoin has 15. Gold is proven through every empire collapse, every currency crisis, every war, every reset. Bitcoin is untested in a true global systemic crisis. We don't know how governments will treat Bitcoin during the next crisis. Will they ban it, confiscate it, tax it punitively? We don't know, but we know gold survives because it always has. For central banks managing trillions in reserves, proven reliability matters more than maximum upside. That's why they're buying gold. Should you have some Bitcoin exposure? Maybe 5% of your portfolio as a speculative asymmetric bet? Sure, but your core protection against dollar collapse should be gold. That's what central banks are telling you. Now let me show you the action plan. What you do this week, this month, and over the next year to position correctly. This week, decide your allocation. Look at your liquid net worth. Calculate 10 to 20%. That's your target gold allocation. Open accounts with reputable gold dealers: APMEX, JM Bullion, SD Bullion, Money Metals Exchange. Research their pricing, shipping, storage options. Open a brokerage account if you don't have one for gold ETFs. This month, make your first purchase. Start with physical gold. Buy 2 to 5 ounces, depending on your allocation target. Don't try timing the perfect price. Just start positioning. Add gold ETFs in your IRA or 401k if those accounts don't allow physical. Get to at least 5 to 10% allocation immediately. Next 3 months, dollar cost average. Buy more gold every month. If gold dips to 2,500, buy more. If it rises to 2,900, buy less. But consistently accumulate. Build to your target 10 to 20% allocation by mid-2025. Then hold. Next 12 to 18 months. Watch the catalyst. Watch for BRICS summit announcements in 2025. Watch for trade deals settled in non-dollar currencies. Watch for further central bank gold purchases. Watch for United States government discussions about gold backing or strategic reserves. Each of these confirms the timeline. And watch the gold price. If gold breaks above 3,000 and holds, institutional phase 2 is beginning. If it reaches 4,000, phase 2 is accelerating. When it hits 6,000, phase 3 retail panic is starting. By 2027, you should be fully allocated and holding. Then you wait for the revaluation. You wait for the United States government to announce the return to gold backing and the revaluation of official reserves to 20,000 per ounce or whatever number they choose. When that happens, your gold position multiplies by 7 times or more. You've preserved wealth while everyone else holding dollars lost 80 to 90% of purchasing power. You survived the reset. You positioned with the central banks. And now you have wealth to deploy into assets selling at depression prices because everyone else is broke. That's the end game. That's what central banks are positioning for. That's what you should be positioning for. Let me show you one final piece of evidence that this is real and imminent. In September 2024, the Bank for International Settlements, the central bank for central banks, released a report on gold demand. The BRICS is the most establishment institution in global finance. They're not conspiracy theorists. They're not gold bugs. They're the people who run the global financial system. And in their report, they stated explicitly that central bank gold demand has been driven by geopolitical concerns, de-dollarization efforts, and preparation for monetary system changes. Read that again. The BIS openly stated central banks are buying gold to prepare for de-dollarization and monetary system changes. They're not hiding it. They're telling you exactly what's happening. The dollar is losing reserve status. The monetary system is changing. And central banks are preparing by accumulating gold. This is not conspiracy. This is official documented policy from the highest financial authority on earth. Central banks bought over 2,000 tons in the last 2 years, more than any period since 1950. They're buying another 1,000 tons in 2024. That's 3,000 tons in 3 years. At $2,700 per ounce, that's $260 billion in gold purchases. $250 billion. That is not normal. That is not diversification. That is preparation for a specific event. The collapse of the dollar, the revaluation of gold, the reset of the global monetary system. They see it coming because they have intelligence you don't. They're positioning because they know the timeline. And they're buying gold because gold is the only asset that survives currency collapse, always, without exception, throughout all of human history. The question is not whether the dollar will collapse and gold will be revalued. The question is whether you'll position before it happens or after. Before means you preserve and multiply wealth. After means you lose everything. Central banks made their choice. They're buying gold at levels not seen in 73 years. Now you need to make your choice. Follow the smart money or ignore the warning. Position with the central banks or hold dollars until they're worthless. The timeline is 2025 to 2027. The window is closing. And once the revaluation happens, once gold is officially priced at $20,000 per ounce, once the dollar has collapsed and inflation has destroyed savings, it's too late. You can't undo that. You can't recover purchasing power that's been stolen. You can only position before it happens. If this presentation showed you what central banks see that you don't, I need you to hit that like button right now and subscribe to Draxiver. Over the next 18 months, I'll track every central bank gold purchase, every BRICS announcement, every move toward the gold-backed currency, every step toward dollar collapse and gold revaluation. You need to see this coming month by month, quarter by quarter. Because the difference between seeing it coming and being blindsided is the difference between preserving wealth and losing everything. Central banks are preparing. 3,000 tons in 3 years. The largest accumulation in 73 years. They know what's coming. Now you know too. The only question is whether you'll act. The choice is yours. Choose wisely.